Hello investors, welcome to our video update for March 9th, 2017. I'm Grant, this is Gary, Adam's our third partner, and we are Dynamic Wealth Management. We are excited. This is an exciting time of year. The market's been moving up ever since Trump took office, and now that it's March, it's time for March Madness. For those of you who know us, we're big sports fans and we love basketball, so this is an exciting time of year for us. So last year we did a pool where we invited all of our clients and all of our clients' friends to join in the pool. There's a money prize for the top 3 people who place in our pool, so look out for an email for that soon. We're going to send that out. Feel free to forward that to your friends or anyone that wants to enter into it with us. We're excited to do that, and also we're excited for this year. There's been a lot of growth in the stock market. Things are looking good.
Absolutely. It's been a good time to be in the market ever since the new administration took office. And it looks like, though, over the last week we've been taking a pause, which we're probably due for that. And that's okay. We'll talk about interest rates. We'll talk about the economy a little bit. But let's go ahead and move to the charts and get you going. Good to be with you, folks. Again, this is our March 9th update. And let's talk to you about, first of all, upcoming events. We continue to do our investments for breakfast, which are done here in the office in our conference room. Very informal meeting for about an hour long. The next one will be Tuesday, March 14th. And again, we provide some donuts, danishes, a little bit of juice, and coffee. And we just go into more depth as far as some of the charts that we're showing now. We talk about the economy, interest rates, obviously the stock market, and so forth. And remember, we do that meeting every 2 weeks. All are invited, clients, non-clients. After that, the next meeting will be March 28th, again at 9 o'clock here in our conference room. You can call and let us know you're coming, or just show up, and we'd love to have you. Let's first of all talk about some key things going on in the economy, and that will kind of set the stage for what's going on in the stock market as well. First of all, we had an exciting week. Plenty of good economic reports and data that came in, not only domestically but internationally. One of the key things that we're watching is we're continuing to see that inflation is picking up, not only here in the U.S. but across the globe, Europe, Japan, and the U.K. And we also had some positive sentiments as far as PMI, which is the Purchasing Managers Index, which tracks manufacturing across the globe, which suggests some strength so far into 2017. The U.S. data also was encouraging in regard to that, and we did have a little weakness as far as spending and construction in January, but we also then saw some good information as far as regional business surveys and some price metrics and labor market indicators, which we'll see here in a second. What all that is pointing to is that with that strong data we've had so far this year, that is really pushing the Fed to kind of go through with their goal as far as raising interest rates, and we'll talk about that a little bit more here in a second as well. First of all, let's talk about inflation, and this is about a week and a half ago, the CPI, or the Consumer Price Index, which is widely viewed as one of the main reports tracking an average basket of goods and services in the economy, and as you can see of late, shown by the blue line ticking up, trending upwards this is as a month-over-month basis. You can see that has increased as we have gotten into 2017. In fact, this report that came out for January came in at a year-over-year increase of 2.5%. And that represents the fastest pace growth for the CPI that we've seen since March of 2012. So as you can see, obviously inflation is rising and trending higher. The other thing that points to a strengthening and stronger economy, and this came out just yesterday, this was the ADP employment report, which tracks the addition of brand new jobs in the economy. In the private sector, we had a consensus view that we were going to get about 883,000 brand new jobs. The actual number came in at about 298,000, obviously much higher than expected, and that surprised the markets to the upside. And obviously, if people are continuing to gain employment and to work and to move up in jobs, then they will continue to spend and move the economy forward. And with that information, as far as inflation and the job market looking fairly healthy, then it's widely expected. In fact, the markets are now pricing in a 90% chance that short-term interest rates will move up again by at least 1/4 point. The next time the Fed meets is just this next week, which is March 15th. And so it's pretty much priced in, baked into the numbers at this point, that short-term rates are likely to go up. And with that information, I'll go and turn everything over to Grant. We'll start getting into the stock market and looking at those charts as well.
All right, well, now that Gary has given us an update on the economy, let's jump into the stock market and see what's going on out there. So here are some year-to-date numbers on the major indices so far this year. So you'll notice we've got the S&P 500 is up about 5%, the Dow up 6%, NASDAQ, so that's technology, up 10%, small caps up 2.5%, international stocks up 4.5%, and then emerging markets up 8%. So wow, these are all of our more aggressive parts of the market. You'll notice the dollar is flat, commodities are down, REITs are down a little, and the 10-year treasury is down. Now, you'll notice that a lot of these things are a little bit more conservative in nature. REITs are getting hurt because of interest rates rising, which Gary already touched on. The dollar is kind of flat. Commodities are down. Treasuries are very, very defensive in nature, and they're down. So far, a very risk-on market year in 2017. Here's the S&P 500. You'll notice right here, actually, is when Trump was elected. And since then, we've been on a tear. I mean, when the market ran up to here, we were all saying, wow, I think it'll come back down a little bit. When it didn't, it just kind of held in there. We thought, wow, this might have some legs to run. And we even have been saying that in our Breakfast Club meetings on Tuesdays. We've been saying, well, this probably will run a little bit more. And sure enough, away it went again. And now we're on a short-term pullback, which is good. It's healthy, actually, to have a pullback like that in the stock market. We like to see that. You will notice, if we look at the trend over the last 4 years, we tend to stay inside of these trend lines. And now sure enough, we're brushed up against the top trend line, and we came down on that. So we're probably due for a little bit more of a pullback here. Nothing too much. The market seems to still have legs, but on the short term, it looks like it wants to go down, maybe for another, a week or so. That being said, here is all of these dips are 5% or more dips. And if you'll notice, the last dip that we had was back in July. So it's been 9 months since we've had a 5% drop. So we're due. We're definitely due. You'll notice we usually have 3 or 4 or 5% drops every single year, and we haven't had one for 9 months. So more evidence that we probably are due for a little bit of a dip here. Here is the Treasury, the 10-year Treasury yield over the last 2 years. You'll notice that it hit a low right in the middle of 2016. Since then, it ran up very strongly. It actually has doubled. Went from 1.3 to 2.6. When you think about it, that's 100% change in the interest rate on the 10-year Treasury. We're on a break right now, or we have been. Now it has stopped and is moving back up again. So with the Fed announcing the rise of interest rates happening soon, we would anticipate to see more movement here in the 10-year Treasury. Here's one thing we wanted to point out. So in our core ETF model in the past, for our defensive position, we've used a Treasury position. So usually right here, this 7 to 10-year Treasury was one that we used as part of our bond position in our core ETF model. Well, this year, 2017, we rotated out of treasuries into floating rate investments, closed-end funds, mutual funds, closed-end funds, mutual funds, and ETFs that were attached to floating rate investments. And those have done much better. So here's the year-to-date returns. All the treasuries are down year-to-date, all of them. The 10 to 20 year, the 20 plus, the 7 to 10, the 3 to 7, they're all down. Now, you'll notice, though, here's the total bond fund that we're invested in. This one's an ETF. It's up. Here's the senior floating rate mutual fund. It's up 1.4 year-to-date. And then here's a closed-end fund that we're invested in right now. It's up 4.4 year-to-date. So definitely a good move for us to move out of these and into these, which our clients have benefited from that move. That being said, let's talk about our allocations real quick. We don't want to take much more of your time. Here's our ratio. So remember, when this ratio falls beneath the yellow line, that's when we make our first change to get defensive. And we are way ahead of that. So definitely with this run that we've had in the market recently, it has built us a cushion. So we would have to see a good 5% or better drop to get us down underneath this yellow line, which would get us in the neutral zone, which means we would basically take some of our risk off the table and buy some defensive positions. And we, of course, would need to go even further beyond that to go to a red zone or a bearish zone where we would get all the way out of the market. So we've got some room, and we actually like that because what it does is it keeps us in. So say we get a drop over the next week and a half, it'll probably bring us back down here, but we stay in, and then away we go again. So we're feeling good about where that's at right now. Of course, we're still in the green zone. What does that mean? That means in our core ETF model that these are our current allocations. If you're a growth client, you're 100% in the stock market here. If you're a moderate client, you're 80% in, and you're 20% in some of that floating rate stuff that we just talked about. If you're conservative, well, you're 60% in stocks and 40% defensive. So all of our clients in all these allocations have been making some good money as this market has ran up, and we love to see that. The sector rotation model has been doing very well. It's actually even outperformed our core ETF model. But here are the holdings currently. You'll notice that we only have 7 sector holdings right now. That was because when we ran our rank, remember we rank these from best to worst, and we only want the best. So when we ranked them, the top 8 showed up just like this: technology, industrials, materials, financials, energy, healthcare, transports, and semiconductors. But we actually don't own healthcare because healthcare violated our 6-month moving average rule. It was beneath its 6-month moving average, and so we did not take it, which has been good because healthcare has been very volatile. So anyways, with that being said, this is performing very well. The green sectors are our current holdings that we have right now in this model, which has been doing very well. That being said, here are our disclosures. We don't recommend that you make any buys or sells on what we have said today. We just simply are trying to give you an education of what's happening out there in the stock market right now. That being said, thank you for watching our video. Keep an eye out for another video very soon. Have a great day. Bye-bye.